Hey friends, the DeFi Doctor here. I'm the head of education at Decentralized Masters, where we break down crypto in a way that actually makes sense. Today we're diving deep into the macro climate to understand why the markets are so red these days. What you understand can't scare you, and the macro climate explains why we really shouldn't be scared at all. There's a light at the end of the tunnel. We're very confident in that. Let me explain why. The first thing to understand is it's not just crypto. It's stocks as well. In total, $5.5 trillion in value has been wiped out of the stocks and crypto in just over the last 2 months. But upon closer investigation, stocks are hurting more. Matter of fact, stocks are now below what they were in early November when Trump was declared the winner of the presidential race. Isn't that insane? All gains driven by enthusiasm for Trump as president are non-existent anymore. The same isn't true for Bitcoin. Bitcoin was around 69,000 then, so it's held up even better than the stock market has. The same can't be said for most other altcoins though. The point here is that yes, markets are red, but this isn't crypto specific. It's because of economic climates, and that affects everything. Now, in contrast, bond prices are up a full 11% since Trump won the election. It's extremely rare to see jumps in bond value like that over just a few months. It only happened 5 times since 2018. So we have a situation where stocks are doing very badly, so are altcoins, but Bitcoin's holding up very well. And bonds are doing very well as well. Why would that possibly be happening? Well, 2 words: government debt. The federal government has to refinance $9 trillion in debt that comes due this year. We think that's the main reason why crypto and stocks have been in red. Let me explain. Trump's push to lower rates. Interest rates are still high, right now in the US at 4.5%. Trump has no power to bring these rates down himself. That's the Fed's decision. Trump can't impact it directly at least. But both of these parties, Trump and the Fed, want different things right now. Trump wants rates to come down so that the government can refinance US debt at lower rates. He cares about this. It'll leave a huge mark on his legacy, and a great one if he actually makes it happen, but it will be a terrible stain if he doesn't. After all, what would have been the point of setting up the Department of Government Efficiency if we were just going to pay trillions more in interest on debt? It's not like Doge is saving trillions or is anywhere even close to that. Trump would be a net negative for the federal budget, and his legacy would be completely tarnished. Unless, of course, he can do something about that interest rate. Now, Trump's already nicely asked the Fed to bring rates down. The Fed refused to do that. Trump can't force them to do what he wants. The Fed isn't subject to his control. So what does the Fed want? Well, they printed money into oblivion during the pandemic, and they want to do everything in their power to keep inflation low. That's Jerome Powell's legacy coming into play. He doesn't want to be remembered as the worst head of the Fed in modern history. So the Fed wants to keep interest rates high to keep spending low, and thereby keep inflation low. If people don't have the money to spend, prices can't go up with the same momentum. Now, when interest rates are high, companies can't expand as quickly because the cost to borrow money to finance that growth is much too high. People lose their jobs, aggregate spending goes down. That's why the 2 pieces of data the Fed relies on most are inflation and unemployment. When inflation goes down and unemployment goes up, the risk of lowering rates goes down. It's less likely that those lower rates cause spending to increase enough to cause inflation. That's what the Fed wants, less inflation. So why am I telling you all of this? Because even though Trump can't force the Fed to do what he wants directly, he definitely can do it indirectly. How? Because he can impact inflation and unemployment. And that's exactly what he's doing. Trump's aggressive trade war can cause inflation. At a surface level, that seems obvious. But the biggest impact of the trade war hasn't been on prices. It's been on the crashing stock market. When the stock market crashes, companies are forced to be more frugal since they can raise less money from selling their shares. That means greater unemployment as a result of downsizing. But a crashing stock market also leaves investors with a question: where can I put my money? If stocks aren't doing well, and neither is crypto right now, the main place to park money is bonds. And that's why we believe bond prices have been soaring. Now, let's recap. The US wants lower rates, but it can't directly force the Fed to lower them. It can, however, force the stock market to crash to to make investors move money into bonds, driving the prices up. When bond prices go up, yields on those bonds go down. It's an inverse relationship. Now, when bond yields go down, the US can start issuing more bonds to finance its debt. Trump gets what he wants. But if it goes a step further, the yield, or in other words, the interest rate on 10-year Treasury bonds is already at 4.27%. That means the interest rate on the open market from bonds is lower than the Fed's interest rate for banks. Banks can just borrow money from the government directly as long as this disparity exists. The Fed's interest rate doesn't matter. If yields on bonds keep going down because their prices keep going up, because the stock market keeps crashing, the Fed will be forced to pivot. We believe that's Trump's agenda. Force the Fed to pivot to rate cutting. Crash stocks, drive bond prices up, lowering their yields below the Fed's interest rate, and force the Fed to lower rates in return. Why does this matter? Now, I spent a lot of time covering this point because it offers valuable insight into what's coming next. The stock market's not likely to see a strong rebound in the next month or two, and sadly, that likely means the same for crypto. Causing pain in the economy that brings the change Trump wants isn't going to happen overnight. Bond prices need to get higher for yields to go lower. The only way to do that right now is by making stocks and crypto a blood sacrifice. Their next meeting won't be until May 6th, and Polymarket shows significantly better odds of rate cuts then. Their decision will rely heavily on bond yields and unemployment data that comes out April 4th. Keeping an eye on the April jobs report will be the best way to determine if rates are going down in May. Now, even though we think it's going to be a tough month or two ahead, we're as confident as we can be that the cycle isn't over. Why do we think that? Well, despite sentiment being low, it's nowhere near as bad as it was in past cycles when FTX and Luna collapsed, or when BitConnect or Mt. Gox went under. Sentiment is poor because of outside factors. That's the key difference between now and those massive, terrible events. Well then, logic says that as those outside factors change, in other words, as the macro climate changes, the sentiment of crypto investors will change just as quickly. It's going to be a tough time to get through, but it's an extremely compelling accumulation phase, one that always seems obvious in hindsight. We hope you don't end up regretting not seeing it that way and not taking advantage of it. Thanks for tuning in to this deep dive of the macro climate with me. If you found this useful, subscribe and hit that like button. Stay sharp, my friends, stay decentralized, and I'll see you in the next one. Cheers.